So I just recently did a video about short selling stocks, and I said I was going to do some follow-up videos on some of the risks associated with short selling. And one of the first ones I wanted to talk about, which was actually suggested in the comments, was what's called a short squeeze. So today I'm going to basically explain what a short squeeze is, what causes a short squeeze, and then I'm going to go through an example at the end of what a short squeeze might look like. Now, if you're not a bearish investor who short sells stocks, you might think, okay, I have no interest in this video. But there are a lot of bullish investors who invest on stocks, hoping for them to go up in value, who take advantage of heavily shorted stocks, hoping that the added pressure of a short squeeze will help that stock rally so they can make money from rising stock prices. So really, there's a scenario, well, there's different scenarios where basically both bearish and bullish investors could potentially would potentially have interest in this information, basically, because I mean, if you're a bearish investor, your short squeeze is like your worst nightmare. But as a bullish investor, if you suspect a short squeeze may happen, it can be a tremendous opportunity for you. It all depends on what your trading strategy is. But anyways, what is a short squeeze? So here's the steps that happen with a short squeeze. Number one is that a stock is heavily shorted by bearish investors. Those are people who are betting on the stock to go down in value. And then what happens is the stock moves up or gaps open. Basically, the stock is then going against these bearish investors who are heavily invested in that stock to go down in value. So what happens is the short sellers then cover, which adds more bullish pressure, and that bullish pressure makes the price move more aggressive. So it's basically like added pressure on top of the already movement of the stock, hopefully in some kind of a rally. It may not be a long-term rally, it may just be short-term excitement around that stock, but that added pressure of short sellers covering will increase the value of that stock or increase the price of that stock. So a short squeeze implies that investors are being squeezed out of their positions at a loss. And the greater the volume is, the greater the price move, because volume, typically greater volume expands price. So as volume expands, price expands as well. They usually have a direct relationship with each other. Volume pushes the stock price higher, resulting in potentially significant losses for short sellers. So what actually triggers a short squeeze? Well, typically it is positive news surrounding the stock or any signs of a turnaround, even a temporary turnaround. And the thing is, guys, even if it is a temporary turnaround, even if short sellers believe it's just temporary, many of them are not willing to leave that stock unattended and leave their short position open and risk runaway losses. Because as we discussed in the last video, the potential for loss with a short sale of a stock is infinite. So many investors, even though it's probably a temporary turnaround or if they suspect it's temporary, they're not willing to just leave that stock, leave that short open and risk losing potentially a significant amount of money. So even if it's a temporary turnaround, they will likely close or cover that position just so they don't have to risk those runaway losses. So what are the factors that go into a short squeeze? It's two here mainly. Number one is short interest, which is the quantity of shares that are shorted and not yet covered. And this is an overall indicator of investor sentiment. And that's basically whether investors overall hope the stock or believe the stock will go up in value or believe the stock will go down in value. And short interest is represented by a percentage of outstanding shares. And that might make more sense when we go through the example in a second here. And then we have the short interest ratio, which is basically the total number of shares sold short compared to the average daily volume. Now, a short interest of over 40% is considered high, and that means that investors are hoping the stock price declines overall. And what's important to note here is that a high short interest or high short interest ratio basically increases the potential for basically a short squeeze. It increases the potential short squeeze pressure at that point when there's higher short interest or high short interest ratio. So basically, this chart is very simply explaining what that might look like. So you have a stock that's going down in value, and so people are shorting this stock. There's a lot of people shorting this stock. And as the stock goes down in value, maybe here's where we see some bullish pressure, maybe there's some good news surrounding the stock. And that is when the short sellers cover by buying shares. And when they buy shares, they soak up some of the supply of those shares, increasing the demand for it. And as a result, the short squeeze occurs where the price move is more explosive than it would have been because all of those short sellers had to cover. So maybe you're starting to see the potential here as a bullish investor if you suspect that there's going to be a short squeeze, where as a result of everybody having to cover, as to not leave themselves exposed to runaway losses. There may be a potential for an explosive price move. So for a short-term trader, you may be keeping basically stocks with a high short interest or high short interest ratio on your radar. But now we're going to go through an example of what a short squeeze might look like. Okay, so here's just a very basic example of what a short squeeze might look like. And it's quite simple. What I'm going to go through is basically how you calculate short interest as well as the short interest ratio of the stock. So we're looking at ABC stock, which is our hypothetical stock right here. And overall, investors are skeptical of this stock. They believe the stock will go down in value. So the stock has 100 million shares outstanding, and of those shares, there are 30 million shares that are sold short. So basically, short interest is equal to the number of shares sold short divided by the overall shares outstanding. So in this case, it's 30 million shares divided by 100 million shares, giving us a short interest of 30%. As we said before, a short interest over 40% is considered high. So this isn't terribly high, but it's definitely a lot of short interest on this stock. Now, to calculate short interest ratio, you have to factor in average daily trading volume. So on this stock, we figure the average daily trading volume is 3 million. So the short interest ratio is equal to the short positions, which is 30 million in this case, divided by the average daily volume, which is 3 million. So 30 million divided by 3 million gives you a value of 10. So what does a short interest ratio of 10 actually mean? Basically, it means that it would take investors 10 days to cover all shorted shares of ABC stock based on average daily volume. So basically, that's the gist of a short squeeze, and bullish investors who are looking for a short squeeze, looking for a stock with a high short interest or a high short interest ratio, are hoping that they can buy that stock and that the stock may come up on value, and as a result push it into a short squeeze where there's an explosive price move where they can make a good amount of money or hopefully some money in a short-term trade. So that's pretty much the trading strategy of a bullish investor looking for a short squeeze. But anyways, guys, that's pretty much all I got for this video. If you guys enjoyed it, I would appreciate it if you guys would drop a like and then consider subscribing to be notified of any future uploads. And as always, I thank you guys for watching this video.